Good evening, everybody, and welcome back to Bristol Talks Economics. Tonight, we're delighted to welcome Matthew Klein, all the way from sunny San Francisco. He's the economics commentator at Barron's and is also the co-author of Trade Wars Are Class Wars with Michael Pettis. Matt, thanks for joining us.
Thank you very much for having me.
As ever, if you've got any questions, queries, or comments, please pop them in the chat and I'll put them to Matt throughout the hour. You can also send them directly to Richard if you'd like. Although I have to say an hour is looking pretty tight to cover all the material I'd like to get through, because Matt has really written an excellent book, and there's a lot of perhaps the historical context at the start of the book, which we won't be able to cover, unfortunately, tonight. So I really would encourage everyone to go out and buy the book if you really want to do justice to the ideas we're going to talk about. First of all, though, Matt, you got your start in journalism as an intern at The Economist, where you briefly crossed paths, albeit virtually, with Richard. Was this where you became interested in international trade? And what was it that finally prompted you to write a book about it?
That's a great question. So actually, my interest preceded the time of The Economist. My first job when I was actually in college, I was an intern at the firm Bridgewater Associates, which is a macro hedge fund, and I was very fortunate at the time that they didn't care that I hadn't actually really studied much economics, because from their perspective, if you're a college student, whatever you learned is not really going to be incrementally more valuable to them than what they already know. So if you learned nothing in college, then they didn't really care, which is a very enlightened perspective that was very beneficial to me. And a lot of the stuff, being in sort of the being a macro fund, you spend a lot of time looking at things like balance of payments and interactions of banking systems, and what are the things that affect interest rates and exchange rates and stuff. And I'm not going to say that I got extremely far along in that process, but it certainly kindled an interest in the subject. And I ended up deciding I wanted to move over in a more sort of a public-facing journalistic kind of role. When I realized that there was all this really interesting stuff that I was learning that was essentially internal and proprietary. And I'm nothing against them doing that, but I feel like it's really useful for other people to be knowing this stuff as well. And this was also during the financial crisis. So I ended up going to work at the Council of Foreign Relations. And actually, I should back up. When I was at Bridgewater is when I first encountered the work of Michael Pettis, my co-author. So he has been writing a newsletter and had been blogging about China in particular, and also other balance of payments and market issues for a very long time. His first book was written before he even moved to China, called The Volatility Machine. That's fantastic. I definitely recommend that. It came out in, I think, 2000 or something. But they were big fans of Michael's work at Bridgewater, and that was when I first really came to learn about him and his way of thinking about things. And that I kept up that interest as I moved on other places and reading his stuff. And at I was fortunate that when I was able to get the internship at The Economist, that he read the stuff that I was the areas that I was contributing to, and so we ended up sort of coming in touch initially that way, and began not like an extensive correspondence, but like we knew each other that way. And then that became the things that he was interested in are very much things that I was interested in. And so as I moved on in other roles, that we kept in touch, and then I had the opportunity to meet him a few times, and by the time we first started talking about this book, it was the end of 2017. I think he'd been thinking about doing this book sort of independently anyway. But he reached out to me and said, have you thought of writing a book? And I said, in general, but not, and we need a sort of a good idea. And he's like, well, I was thinking we should do something on trade, or he's thinking I should do something on trade. Do you want to work with me on this? And I said, that sounds, fantastic. And, we had sort of an outline, and, went from there.
Yeah, I think it's interesting talking about the fact that you didn't study economics at an undergraduate level, because I think there are a lot of misconceptions, and you only spend maybe a paragraph in the book talking about Ricardian comparative advantage. But I'm currently doing an international economics module at a different university as a year abroad. But you can sometimes get bogged down in those intensely theoretical ideas, which, as you show, don't really apply in the current situation where financial imbalances are is what's driving the trade imbalances. So first of all, there's three really eye-catching case studies in this book. You look at Germany, the USA, and China. I'm going to start with the latter. China's been pursuing something called the high savings model for a number of years, but it's potentially running into significant trouble. Could you take us through what the high savings model exactly is, and then maybe the 4 stages of Chinese growth since Deng Xiaoping?
Sure. So that's a very big question. We spent quite a few thousands of words on it in the book. But basically, the way that economies can grow over time is by increasing investment in productive capacity. And the only really 2 ways to do that at a very basic level: either you get other people outside of your own society to help, cover some of your own domestic needs, because if, or you basically squeeze your own domestic consumers and sort of redirect resources away from them, or you do some sort of combination, right? And so you can think of sort of extreme examples of this, like the Soviet Union under Stalin is sort of an extreme case of you don't want to rely on foreigners at all or as little as possible. So you squeeze your peasants, you get some kind of surplus in agricultural goods. You have people in the gulags digging up industrial metals, and then you barter with the Nazis for advanced machinery, and then you can industrialize that way. That's sort of one extreme. That's essentially high savings insofar as you're consuming less. That's how the technical definition of what saving is consuming less or not consuming. The other way of doing it is you can essentially entice other people in the rest of the world to invest in your economy and participate in your growth. That's sort of what the US did in the 19th century. That's what South Korea did after the Korean War. Most countries they industrialize are sort of a mix of those two. There's some intermediate point, I mean, including the US and Korea. China is not as extreme as the Soviet Union or Stalin, obviously, but in many ways actually is pretty extreme and became pretty extreme over really since sort of the early 1990s. And the basic premise of this is that if you have a lot of investment opportunities that haven't been taken advantage of for a reason, and in China's case, we're talking well over 100 years of either civil war or revolution or foreign invasion, things like that. So there really is a case for saying that, like, relative to sort of the overall level of education and development and so forth, institutional capacity, there wasn't a lot of investment. Really, anything you can do to channel resources away from the production of consumer goods towards infrastructure investment or manufacturing investment in manufacturing capacity would be constructive. And that happened in the 1990s. There are a lot of ways of doing this. One thing that's relatively known and notorious is that local governments would basically expropriate peasants for their land and give it to developers at relatively depressed prices, and then the officials would certainly get a cut. So overall, you can think of this as sort of like a overall society might be better off because of all the new stuff that happens, but it's also depriving a lot of those people. You can think of the treatment of environmental regulations for a long time as being sort of similar in the sense that it's a subsidy for business investment at the expense of households. There are a lot of other things we talk about in the book that are sort of specific mechanisms. One of the issues that happens with this, though, is that you end up having an imbalance show up somewhere of if you're investing a lot and people to create more and more productive capacity, then there has to be demand for the stuff that you're ending up being able to produce, or there's going to be a problem one way or another. And initially, that demand was found outside of China, and that's why essentially this period of the 90s and particularly the 2000s up until 2008 was mirrored by this massive increase in China's trade surplus with the rest of the world, and commensurate increase in indebtedness with China's biggest trade partners. Then you get past 2008, and essentially the US and Europe are just not consumers there for a variety of reasons are not able to borrow and spend as much, or they're not going to. And so the Chinese government essentially does essentially what you might think of sort of a traditional Keynesian response of saying, well, if this source of demand is gone, we're going to do what we can domestically to offset that, which is sort of good traditional macro policy in a lot of ways. But the cost of that is that you essentially have a big increase in debt domestically in China, because the investments that they come up with at that point in China's development were not really as productive as some of the ones from, say, the 1990s and 1980s. And now you're getting trying to change the stages of Chinese growth. To get back to your question, you can think of the end of Maoism period, sort of from 78 to sort of 89, as basically you have strong growth led by productivity increases from essentially liberalization. That then breaks down as you have this sort of mismatch between the urban and rural economies, where one of the consequences of the fact that the rural economies liberalize much faster is that you have a big increase in food prices, which is basically offsetting the fact that the peasants had been squeezed for a very long time under Mao. But that leads to a lot of instability, and coupled with the political instability that was occurring because there was a lot of ambiguity about what would be tolerated. As things were liberalizing over that period, you have the pro-democracy movement, and then it gets violently crushed. You have initially some orthodox communists coming in and saying this sort of discredited Deng's whole program, but then they basically end up trying to roll back liberalization, lead to the closest thing that China had had really to a recession over this whole period. Deng comes back in 92. I mean, never like completely gone, but right, more influence in 92. And this leads to the view of, okay, if we're going to have to generate as much growth as quickly as possible, this is where they get to the investment-led push that I was talking about. Just, okay, we're going to redistribute resources from consumers towards either local governments or businesses affiliated with the state, whether they're state-owned or not. That distinction doesn't really matter that much. Then by the time you get to that plays out in various ways. There's a big change. You get to the late 1990s with the Asian financial crisis, and there's a Chinese sort of domestic banking crisis, isn't necessarily the right word, but there's a lot of losses in the bank system that are redistributed to households. Then you have the global financial crisis. Then you get to sort of, you could say, the third stage of Chinese growth is this transition I was talking about a little bit ago, where as external demand is not there to the same extent as it was before, there's a big increase in domestic indebtedness, whether it's by Chinese businesses or local governments, as you have this big investment push to offset the loss of the U.S. and European markets, export markets. But those investments aren't very productive, so Chinese growth ends up slowing very dramatically. Debt to GDP ends up rising very dramatically, and eventually the government ends up responding by trying to slow investment growth and slowing borrowing, and that's sort of what called the sort of the fourth stage. Or alternatively, you can think of the fourth stage hasn't happened yet, which would be a real set of reforms that actually lead to sort of a redistribution of income and purchasing power back towards households, because the situation as we've had basically over the past 10 years or so is that households in China have only consumed something like a third of, somewhere between 35 to 40% of the value of what the Chinese economy produces, which is extraordinarily low. You basically only see those kinds of numbers either in sort of corporate tax havens, where the GDP numbers don't really reflect, domestic conditions anyway. You see it in maybe some sort of oil sheikdoms when the oil price is very high, and again, that's like sort of a temporary windfall. Or you see it in, I mentioned earlier, the Stalin Soviet Union. It's extremely rare to see the household consumption as a share of economic output being that low. And so the question is how you're going to raise that. And so far, it doesn't look like, it's something that is on the minds of China's leaders. It has been for a while, but the changes that would be necessary haven't yet happened.
Oh, thank you very much. That was very comprehensive. That's probably a bit unfair of me to give such a big question at the start. I just thought it was kind of important to try and flesh out some of the key points of the book. And obviously, the largest one is there that you're talking about. It's an expropriation of the elite. The elites are expropriating from the working population. The Chinese people only consume a very small fraction of what they produce, which is then played out on a global scale with large imbalances. And I think one of the most interesting things that you talk about is the fact that although China is only a middle income country, it's sort of already hitting that ceiling of running out of productive investments. And that's sort of each country has its own optimal investment level based on its institutions. Could you talk more about that institutional argument of why China is struggling to find productive investment?
Sure. So this is something that goes. This is an old idea. That's definitely not original ours. But essentially, you can think of it as if you take a society. I mean, a lot of what makes any investment valuable are people's, confidence in their ability to make long-term plans. I mean, this is sort of, you're willing to make commitments, and you're willing to trust people that aren't necessarily related to things like that. The qualities of a legal system. There might be, the nature of the bankruptcy regime. I mean, something that people talk about is why America has done relatively better at fostering innovation than say continental Europe is because for a variety of sort of essentially, coincidences. It happened to be the case that a lot of people who came to the U.S. early on are people who were fleeing debts or had been indentured servants, and so they were relatively more favorable to getting fresh starts. There's also a story about how I think one of George Washington's good friends basically ended up being bankrupt for sort of a accident and so that sort of influenced the development of the U.S. bankruptcy regime in like the late 1700s being different from what it was in Europe. And yeah, that's sort of something now people think is actually a big deal. Being able to get a fresh start is valuable. There are a lot of these sort of institutional differences that affect growth and living standards, and I'm not going to pretend that people really understand what they all are. But the idea being that you can give a society, if you have a society that doesn't have certain these prerequisites, you give them a lot of physical stuff, the amount of value that they can extract from them might not be as high as you'd think. Conversely, if you don't have a lot of physical stuff, but you do have a lot of these other prerequisites, then you could, very quickly become much more prosperous by, adding, physical capital. And I mean, that's sort of, sort of an obvious case of this is like Europe after World War II. You have massive amounts of destruction in most of the continent. A lot of factories and buildings have been destroyed. And you might think, oh, wow, they're like a really poor society now. but it happens to be the case that, nobody forgot how to do things. In fact, they'd learned a lot in the past, partly during the war. And so you're able to rebuild extremely quickly. And by the time you get to sort of late 1950s, early 1960s, Europe had effectively not only caught up with where it had been, but, vastly surpassed living standards, pre-war. And in fact, it converged relatively to sort of where, on a sort of relative US basis. So, it goes the other way too, right? Which is, you look at China's not unique in this, but there are other societies in the past that have basically said like, okay, we're going to squeeze consumers to just put as much resource we can into either business investment, infrastructure investment. And at first it looks really promising. And then you sort of hit a wall where, people can't actually extract as much value from those investments as they thought they could have. So, I mean, Brazil, the sort of military dictatorship in the 60s and 70s did something like this. And there are other examples as well. And you could argue, I mean, basically the kind of institutional change that would really affect the dynamic of how much, investment is valuable or not. I mean, it does happen, but, and it arguably happened, I think, very clearly in China with the transition from Mao to Deng, and then there were subsequent reforms after that. But, there hasn't really been kind of a similar, big change, in a while in China in terms of the things that would make additional investments more valuable or productive for people. And in fact, you could argue, in fact, it's gone the other way, with increasing levels of repression and state control, uh, particularly under Xi Jinping. So, you can therefore, I think, make a reasonable case that it's not, and it sort of shows up in the data, right? Like if more investment were the thing that would help China grow faster, then you wouldn't be seeing A, China's growth rate slowing down, and B, you wouldn't be seeing the debt to GDP ratio rising the way it did. And so that sort of suggests that they've sort of hit an institutional limit, and they seem to think that as well in terms of why they're trying to push down the investment growth rate. I think another interesting case of where institutional change leads to a real sort of step level change in what the amount of investment and the value you can get out of investment would be Central and Eastern Europe after the end of communism, where you had societies, and it kind of goes both ways, right? Like so, Hungary and Czechia and Slovakia and stuff were relatively more advanced, before they were taken over by the communists, compared to sort of Western Europe than they were during the communist period. And then sort of they lost ground, and then communism ended, and then they sort of reintegrated back to a higher level. And so you can see this kind of going both ways. But I mean, it's basically, yeah, I don't want to say it's quite cargo economics to say, the idea that like you can just give people, sort of an advanced factory, and then if they don't know how to use it, they won't get anything out of it. But I think there's sort of a, there's a I think the focus on just like if you build a lot of infrastructure, you'll automatically be a richer society. You have to be careful. I mean, Michael has a phrase which is that like, it's not that poor societies have less capital, or sorry, poor societies aren't poor because they have less physical capital. They're they have have this physical capital because they're poor and aren't able to make the best use of it. And I think that that's a really interesting way of looking at it. I mean, there are other sort of scholars of development who made this. I mean, Hirschman, Albert Hirschman has made this as well. I hope that gets your question. I guess it's sort of a little bit of a rambling answer,
No,
but
great. And let's just nail down exactly. So why is it so damaging to the global economy that China has a huge surplus? How does that distort everybody else?
so the way I would think about this is that the surplus reflects the problems that are internal to China and that affect the rest of the world. It's sort of the, you know, this is something that comes up. People talk about like, oh, like trade imbalances aren't bad, or like what, right? Trade imbalances themselves don't tell you anything, right? It's about, they reflect other conditions that matter. And so in this case, what matters is that the two kind of odd features of Chinese society, the most important one being that households in China are not, household income is suppressed in China, and household consumption is suppressed even more. And so basically, you're talking about a country of 1.3 billion people where they're able to produce a lot, but the living standards of most people who live there are not commensurate with the value of what they're able to produce. And so that's bad for them. I mean, that's sort of like the first point. That's just really bad for them. That's an enormous number of people. And there are a lot of, China may have, has made tremendous progress in raising living standards of people who live in China over the past, 40 years, but it's still the case. There's a tremendous amount of poverty within China. You know, Westerners tend to see sort of the most advanced, the richest cities on the coast, but it just as the richest coastal cities in the U.S. are not necessarily reflective of many parts of the rest of the U.S. It's also true with China. So you have an enormous amount of rural poverty, things like that. So they're losing out. but there's also a corollary because the world is a connected global system. If all of the people if all those people in China are living below their means, or what they should be their means, I should say, um, then that also is going to have effects on people in the rest of the world, because people in the rest of the world who make things and provide services to other people are missing out on all of those customers. And so insofar as there's the situation in China creates an imbalance between all this stuff getting produced and not in a commensurate increase in demand for other things produced elsewhere, that creates a real problem for people everywhere else, where they might be able to get cheaper stuff, but if they're not able to generate income themselves from selling things to people elsewhere, then they're going to end up worse off. And either they're going to lose their jobs, or they have to take out more debt to sort of compensate. And that's essentially the problem. And that shows up in the form of these trade imbalances and rise in indebtedness.
Yeah, we'll get to that with the US in a second, but just it's kind of, you can understand in a way that large surplus is allowed to be sustained in a country like China, where it's a more authoritarian regime. But in a country like Germany, it's democratic regime, but this same surplus has been able to persist. Sort of, you describe how it's built up after the fall of the Berlin Wall. Can you talk, maybe perhaps not as in depth as China's development, but about a couple of the key features about Germany's own class war and how that's led to their surplus?
Sure. And it's really interesting because, as you said, they're very different societies in terms of their politics, and yet they ended up in kind of the same place in some ways. In fact, actually, Germany's surplus has been larger and more persistent than China's surplus, which is sort of the opposite of what you might expect. And I mean, there are a couple of points here that are interesting. One is that Germany, being a relatively smaller country and more integrated into trade with its neighbors, you have a lot of German businesses that always has been the case where their main customers are outside of Germany. And so I think that is an important factor here. So basically, if a lot of those businesses are able to maintain their sales to people outside Germany, and then they cut their costs by, either firing people or just not giving people pay raises, that is going to end up sort of mechanically, as long as there's sort of a rise in spending in the rest of the world, relative to income, which is what happened in there among Germany's neighbors, that can play out, and that's exacerbated by um, the German government having this real belief that the welfare state that was created and the expansion of the welfare state to the east after reunification needed to be trimmed and cut back. And so essentially what you had, sort of two developments at the same time. One is that German businesses, they have this big cut in the tech bust was really severe there, and at the same time they felt pressure from sort of the slowdown within Germany after reunification, and they saw this big opportunity to offshore production to Poland, Hungary, Czechoslovakia, and move it out of Germany. And at the same time, the government says, well, unemployment's very high, and we can reduce unemployment by basically making unemployment intolerable by cutting the benefits for unemployment, and that'll also help us. We'll get more Social Security tax revenue, and so you basically have a lot of people pushed off of jobless benefits into these sort of low-paying part-time jobs. The net effect, I mean, it basically drives down the headline unemployment rate, but the household income doesn't really move at all. In fact, the poverty rate of people with jobs goes way up. And the net effect of this is that German companies that are selling to their neighbors are continuing to sort of have their revenues grow in line with their global GDP. But German domestic demand, whether it's consumption, investment, is growing much more slowly, and so that leads to the big expansion of the surplus, and that has continued to persist for 20 years.
Yeah, so that's sort of the Hartz IV reforms that you're talking about there.
Yeah, that's part of it. That's the unemployment and benefits change. Yeah.
Yeah, and I think one of those things that is sort of, as Paul Krugman would say, sort of pop internationalism. You'd think that, oh, well, just because Germany has a large surplus, that means it's actually really competitive. But what you actually show is that's because of it doesn't import as much, because again, it's extracting resources from the working class towards the elite. Could you talk a bit more about why competitiveness isn't all it's cracked up to be?
Sure. So, I mean, two things that are really interesting here is, one is that if you look at the growth rate of German exports during the period when the surplus is rising and when it's been large, it's actually much slow. That exports grew much more slowly. The volume of German exports grew much more slowly, basically since 2000, than it did in the 1990s, when Germany essentially had balanced trade. The thing is that import growth was even slower, and that's a different one. So, like, clearly, it's not a situation of everyone saying, "Oh, well, German exports are much more competitive or much better." The other point is just sort of at a sort of basic principle level. Like, if you are able to make really high value products, the reward for that should be you get to enjoy better imports and more imports. I mean, sort of the stereotypical case is like, you work hard in the factory and then you get a nice vacation in, Sicily or something, right? Like that's how it's supposed to work out. The fact that it didn't work out that way, you only have the half of it. And so that's sort of the problem is that, and I mean, you can think of this as the analogy of the China situation, right? Like Chinese workers have been able to produce an enormous amount of things that people in the rest of the world want and people in China want, but for a variety of reasons, people in China aren't able to actually consume all of that value that they're producing. And so that's the issue, and that's what happens in Germany as well. So when we talk about the competitiveness, what in practice what that means is it's just that the profitability of German businesses went way up at the expense of German workers. In fact, you look at the period between sort of 2000 and 2007, the share basically said this massive increase in profit margins, and I think like the share of total income growth for like Germany as a whole that's attributable to basically profit margins or profits and things like that was like 2/3 or something. I mean, like basically like it's enormous shift in the distribution of income there. Some of that's reversed since then, to be fair, but that was like the period. That was what drove the growth of the surplus. And then essentially, what happened after that is you have sort of the government coming in and basically deciding it's going to, even as these have sort of rebalancing towards workers' wages, they're just going to tax it more. And that's why Germany's surplus with the rest of the world has been relatively stable.
It's interesting because in the UK we often look longingly at Germany as such a competitive neighbour and think, oh, wouldn't it be great? But yeah, like you say, the key point is also to allow workers to enjoy the fruits of their labour as well as
Right.
being competitive. And one of the things I didn't realise is you talk about in your book about how German broadband is some of the worst in Europe just because they're not investing and they have this pathological obsession with the Schwarz Null. But again, I think potentially the pandemic's been quite a large straw that's broken the camel's back on that. Do you have anything regarding that?
Yeah, it is interesting. I mean, I feel like it's a little too early to tell, but it definitely seems like the debate in Germany is shifting. I mean, I feel like it was shifting a little before the pandemic in terms of, I mean, the stuff we're saying is not unique to us. I mean, there's some really interesting German economists who we cite in the book, people like Marcel Fratscher, for example. But it was never part of sort of the mainstream political discourse. I think the fact that the German government responded to the pandemic so far the way it has is actually very encouraging. I mean, the German government's fiscal response in 2020 was basically the same size as the US's, which was the biggest in the world more or less as a share of GDP. So I don't know if they're going to continue doing that. I think that we're sort of seeing a divergence opening up this year. But I mean that plus the fact they're willing to endorse the recovery and resilience facility that allows the EU to borrow as a whole, I think is encouraging. So there are definitely positive dynamics there. But I mean, to your what you were saying, I mean, Germany is also one of those things that like a lot of people in the US like look very admiringly, and it's what is actually competitiveness? It's really just like if you define competitiveness as labor costs as a share of the product, then like you can become more competitive just by like having higher profit margins and harming your workers. It's not but that's not really increasing your competitiveness in sort of like a meaningful, like you're making a better product necessarily. So um that's sort of a key point. I think that, I mean, if the mechanically, like if the labor share is lower, then you'll appear more competitive by the sort of a lot of common metrics, but it's not really, I think, a useful in one of the things we say is everyone tries to do that, then you have a real problem because, ultimately workers are customers. So either someone else has to be picking up the slack by borrowing more, or we'll just have, lower demand as a whole and you'll sort of all fail.
Yeah, I think that's the thing. Germany can pat itself on the back if it's just doing that by itself, but if everyone does it, then you're in disaster. And as you say in the book, Germany's surpluses is what contributed, for example, counterintuitively to the Spanish housing bubble before the financial crisis. Could you maybe just briefly sketch out how that can be linked and how it's not all down to the greedy Greeks?
Sure. So, every transaction has two sides. So if someone is, if Germany is having this surplus because, German businesses are able to just keep selling to the rest of the world, even as Germans aren't spending on themselves, then the flip side of that is that other people, the rest of the world collectively must be spending a bunch more than they're necessarily earning themselves. And in the German case, a lot of that was absorbed, a lot of that imbalance was absorbed by Germany's neighbors, Spain, Italy, Greece, Portugal, Ireland, the UK. And, that was channeled primarily through the German banking system. So one thing, you can look at the monthly data the Bundesbank puts out, and basically what you can see is that up, from 2000 to 2008, you have a situation where German banks just massively increase their lending abroad, without borrowing. I mean, they do borrow more from abroad, but there's a huge difference, and that difference basically is the entire trade surplus. Um, And so one way of looking at this is that, to oversimplify only slightly, a lot of German companies, particularly ones that are owned by sort of rich German families, the share of German businesses that are family owned is very high, part because of the sort of weird inheritance tax rules that they have there. And uh, they basically, cut their worker pay, have big increase in profitability. They don't invest, so they basically, you could sort of say they effectively, stuffing that money in the banks, in the German banks and deposits. German banks are then looking for opportunities with, put that money to work, as it were, and they make loans to, people in, whether it's Irish mortgages or, Greek government bonds, that sort of thing. Now, of course, to be fair, this is a simultaneous process, so it's not like, I'm implying like one and then the other, but it really has to be at the same time, because the only way those companies are able to maintain their sales, even as they sort of cut their own, worker pay and stuff, is if someone else elsewhere is borrowing to spend and make up that demand. So, you could just as easily tell the story, although I think it would be wrong given, sort of the narrative that we have here, that, oh, it's because the Greek government suddenly decided they wanted to like borrow a lot more to buy German made submarines, or because Spanish homeowners, suddenly wanted to, develop a lot of property on the, Mediterranean coast, that enabled German companies to suddenly get this windfall in profits that they, but I don't think it's quite the right way of thinking about it, but these things all did happen simultaneously. Um, and because they happen simultaneously, I mean, this is why, because it seems, we sort of look at the order of events of what was going on, and I do believe that it was really the changes in Germany that were sort of the ultimate driving force. That's why we can say, okay, like there was some sort of corresponding thing here. And in fact, we can look at sort of, there was a sudden change in, say, Spanish financial conditions, that Spanish banks had been, I'm not gonna say the Spanish banks were sort of uniquely conservative, but basically they sort of became extremely willing to lend against rising property values in the 2000s, in part because they were accessing all this sort of extra funding. I mean, there's a great, so Hun Song Shin at the BIS is this great chart he made a few years ago, basically looking, if you look at sort of core liabilities of the Spanish banking system, they didn't rise, particularly rapidly during this period. The thing that really rose dramatically was, he calls non-core liabilities, but a lot of that includes, borrowing from abroad. Um, and so you can basically say like Spanish banks borrowing from German banks and others, but like, ultimately, sort of, and, that led to a big change in credit standards within Spain that led to, all this other stuff. And you can see this in other countries. And then that flowed through to, if Spanish homeowners are suddenly feeling richer because their house has gone up a lot, and they borrow against that, then they can buy more stuff, some of which may have come from Germany. And, that flows through. And again, I mean, you have to sort of zoom out and think of a global system, because otherwise, if you look at sort of each piece individually, it might not necessarily make sense how they connect, but then like they all do have to fit together. And that's sort of why it's useful to sort of try to look through sort of the historical account and see where is the change coming from.
Yeah, I think that point is kind of important to emphasize when you say one of the key themes of your book is choices made somewhere can have unintended effects elsewhere, and it's all, yeah, it's very globally connected. Just as a little aside, you talk about one of the airports that was built in Spain before the crisis, Don Quixote Airport. But I was looking, just preparing for this talk, and they've actually found a use for it during the pandemic. It's been used as for all the grounded aircraft, because there's no flights. They're parking all the aircraft at this ridiculous airport that's built miles from any city. So that's quite an interesting use of this non-productive investment. But yeah, I think we should now turn to the US, which is obviously what's backstopping this large imbalanced system. And can you talk about why, rather than being an exorbitant privilege, being the world's reserve currency is actually an exorbitant burden?
Sure. I mean, I will also just say that the U.S. is not unique. It's the biggest one. And we're American, so we're, writing for primarily a U.S. audience, but the UK, Canada, Australia are in many ways very similar situations. I mean, all the sort of major advanced English-speaking economies. And in fact, I think a lot of the things I will say about the U.S., I think very much kind of carry over and explain the UK as well. So, since this is UK audience, um, the the first thing is that, being your reserve currency is not something that the reserve currency issuer chooses. Ultimately, it's about what people outside choose. Why do they want to hold a particular currency? And ultimately, that comes down to, what can you use that currency for, and how trustworthy, what are the quality of assets that you can get with that currency. And so, if you think of reserve currency, like why do you hold a reserve currency in the first place? What's its point? You can think of it, there are a couple ways of thinking about it. One is like, it's your emergency savings account. maybe you have an unexpected bill coming due. You want to make sure you can pay for it, or you're worried that if you're a government of the managing your reserve, like a literal reserve manager, you're thinking, okay, like we have some external debts that are due, or we'll make sure that we can cover a certain amount of imports if for some reason something happens with our own ability to export, to pay for imports, things like that. And you say, okay, well, given that, you want to have the currency in either what are the markets where that's easiest to borrow money in the first place. Biggest, most deepest, most sophisticated financial markets. You want to hold stuff in that, and what is sort of an economy that produces the most range of stuff that you could buy, or where other people are willing to denominate those things in that currency. And you're going to generally say that dollars are going to be the most valuable thing for that. It's not the only one you'd pick, but dollars would definitely be sort of the biggest. And then you can also think about as a sort of different perspective, like I just want to have someplace safe to put my money. Maybe you're not necessarily the reserve manager for a government, but you're just a rich person somewhere in the world, and you're thinking like, I'm worried about potential instability somewhere, maybe in my home country, you're a Russian oligarch or some Saudi prince, and had an unfortunate episode of the Ritz-Carlton or something. Like you're thinking, where can you put your money that's safe? And you say, okay, well, you want a place that has a legal system that's very investor friendly. You want to be able to understand the language, which means probably English, because that's sort of the universal language for, especially for rich people. And again, you want to have like these sort of deep, sophisticated financial markets. And so again, that's going to narrow it down to being basically the US, UK, and to a lesser extent, Canada, Australia, which is what we see in the data. That's where people, whether it's Miami condos or Mayfair houses, or all the a lot of rich Chinese getting houses in Australia, New Zealand, Canada, especially if they come with residency potential. So that then has sort of weird effects on the people who live in those countries. Not necessarily bad, but in the sort of the modern period, they are bad. They'll be distorted. So essentially, like if you think of your financial system as sort of having dual purposes, one of which is to serve the needs of the people who live in your country, and then the other one is having this global, meeting this sort of global demand for your assets, that's going to lead to sort of different effects and potential distortions. So if you, if people in the rest of the world really want to buy your assets more than the people in your society want to issue assets for their own needs, then there's going to be an imbalance there. I mean, one potential option is that just the prices of those assets is going to, go way up. You can sort of see that in like, Australian, Canadian housing, for example. And in fact, that's why the governments there have been trying to, and New Zealand have been trying to, restrict foreign buying explicitly for that purpose and for that reason. The other thing that happens is that you just create more assets. And so especially if you're dealing with societies where the financial sector is relatively flexible or capable or creative, whatever word you want to use, people can come up with that. I mean, if people say there's a strong demand for, US dollar fixed income, there are plenty of people who are very well paid who can figure out how to create more US dollar fixed income for them to buy. That might have all sorts of negative consequences later. And I mean, it did, but like essentially you can look at the whole, mortgage bubble and bust as a product of that. And I mean, it's not uniquely a function of people outside the United States. There's also, people within the United States who wanted to buy fixed income, whether it's pension funds or other rich people, rich Americans. But if you combine that with the demand from the rest of the world, whether it was Europe or China or Japan or other places, that led to this massive increase in indebtedness, in that case by U.S. households, which was able to finance more consumption than otherwise would have been the case, and then reverse, because an increase, if people are just borrowing against a rising house price, that's not really sort of a sustainable, sort of the best case scenario is then like it just house prices don't go down, but and debt levels aren't forced to contract, but that's the best case scenario. That's not what happened. So that I think gives you a flavor of kind of the distortions that can occur. The other thing, of course, that's related to this is you're creating assets, but also if people are buying your currency, they're pushing up the value of that currency relative to others, and that's going to have effects on your tradable goods sector, or really anything you trade. So your manufacturers are not going to be, or have a harder time competing against imports. They're going to lose market share at home, and they're going to lose market share abroad. So they can't make it up with exports either, because their exports are going to be relatively more expensive. And so again, that's something you see in all these societies of relatively losing out because of overpriced currencies. And so this is true for dollar. It's true for sterling and Canadian dollars and so forth. And it's not a coincidence, I think, that the current account balances of trade for all these countries have been pretty consistently negative and about the same size as a share of their economy for a few decades.
But yeah, what's interesting is that after Bretton Woods, this is what the United States wanted. It wanted to be in charge for more perhaps political reasons. But now, since Nixon took the US off the gold, it has become this exorbitant burden. And I think it's kind of slightly hard to get your head around. And you talk about how economists like George Stiglitz get this wrong. Is it's not the fact that American consumers are being profligate. It's more the fact that American consumers are forced to absorb this glut of savings. But yeah, I think that it's a very counterintuitive idea, which again I think is why you need to read the book. Um, but yeah, is there anything else that can help explain why the US consumers are like forced to take on excess goods and why um, this is what makes the system so unbalanced?
Well, this is why it's useful. I mean, it's sort of the flip side of the Germany story, right? Is people who look at Germany's trade surplus and say, ah, it must be because German exports are really good. But then you look at the actual data on exports as opposed to the net balance. And you say, okay, well, exports didn't actually grow that much. What happens? Imports are really weak. And you can sort of do the mirror exercise for the US, which is that the trade deficit in the US and the rising consumption, household consumption share of GDP in the US was not due to the fact that imports were rising really rapidly or the fact that consumption was growing really rapidly. What actually was happening was that in the US, it was exports that were weak, and in particular, incomes and production that were weak. And so the fact that the consumption share was rising and that consumer indebtedness was growing so much, it wasn't because people were living way beyond, they were living beyond their means because their means were shrinking. And that's a very different story from the idea that consumers are being incredibly profligate. It's a different story, by the way, from what happened in, say, Spain, where Spain was a relatively healthier case, where like the domestic economy is doing well, and then you sort of supercharge it with this extra borrowing and sort of change in financial conditions. In the U.S., you have a very different story, and that that's why profligate. If put it another way, if American consumers had consumed less and been less profligate, then global demand as a whole would have been even weaker in the 2000s than it already was. And then sort of the bigger problem, macro problem of too much productive capacity, not enough consumer spending would have been much bigger. And I think quite plausibly we could say that, like, instead of saying that the early 2000s recession people talk about was like relatively mild, I mean there wasn't even one in the UK for a lot of other countries. It would have been basically like 2008, just drawn out for a long time, because that's essentially sort of the world we ended up in during the financial crisis. Was you remove that sort of countervailing impulse. So yeah, I think this is why it's really useful to sort of break down what are the things we're talking about, like what are all the components that explain these ratios and net figures, and like you can actually just see and then you can judge better what's happening there.
Yeah, so the solution really lies more with the surplus countries rather than with the deficit countries. But perhaps short of Germany and China voluntarily deciding that they're just going to give their workers more of their production, you talk about a potential solution. Well, you could call it perhaps a new Bretton Woods with a new global currency. Could you elaborate on that a bit?
Yeah, so I mean, as you were implying, there are multiple ways out of this problem, and the most straightforward one is just that if societies generally, I mean, including in the U.S. and U.K., which have their own issues with this, but if everyone, particularly in the surplus countries, there's a sort of a redistribution of income and spending power to ordinary people, that would solve everything. If one other thing you could do on top of that that might sort of prevent recurrences is to the extent that a lot of cross-border financial flows lead to the transference of problems in one society to others, is essentially, you can think of it as the costs of the misallocation of income within Germany and China are distributed away from those societies to a degree through the open trade and financial systems. So you can imagine that if there were some way of gumming up that process, that internalizing, having those societies internalize those costs, then that might encourage constructive political changes there. And one way you could do that is you could essentially go back to sort of the original vision that Keynes had at Bretton Woods, is saying, like, instead of having open capital accounts and having trade denominated in whichever currencies without limit, essentially, and cross-border finance being unlimited, you would basically have some kind of restriction. This is something Mark Carney talked about recently, like a year or two ago, I think, about having basically a different settlement currency specifically for cross-border payments. And that would be with the IMF's in charge of that. I don't know, right? Like, we didn't sketch this out very deliberately because this is not like the main point of the book. It was like, and there are a lot of different but I mean, you could eventually, you could imagine a situation where, I mean, basically, like, not having it be the dollar, not having it basically not having countries' currencies being used by people not in that country for reasons that have nothing to do with, like, directly interacting with people in that country, and then hopefully avoiding some of the various financial and economic distortions associated with that. And there are a lot of different ways of getting there. So I don't want to get too much in the specifics. So I mean, there's a reason we sort of hint at this in the book, but that's an option. I mean, as I said, the sort of most straightforward, simple option is having a better distribution of income and purchasing power, which doesn't require something like radical and creative, because we've done this before and we know roughly what's involved.
Yeah, your book is uplifting and optimistic, but I just, unfortunately, the sort of the last words of it, where it talks about a spirit of global cooperation and egalitarianism, we're perhaps not seeing as much of that at the moment with vaccine distribution as we should be. So maybe that's going to curtail a nice global solution. Just perhaps maybe one final question before we turn to audience questions. I just wanted to ask you, you've interviewed, I think it was Amir Sufi, and how does your framework sort of link to the indebted demand framework, which students might be familiar with in this call?
Yeah, so very similar. I mean, it's funny actually, because that paper came out basically right after we'd sent in the absolutely finalized manuscript of the book, and it's like, oh, too bad, because we definitely would have loved to have cited it in the text. But yeah, I mean, it's completely, I think, consistent with it. I mean, one of the points, and there's also the other paper that they did, the Savings Glut of the Rich. It's a very similar concept, which is essentially, if you're having if you have sort of, sort of oversimplifies, like, most people who over the course of their lives spend everything they earn on goods and services, thereby generating income for other people, and then you have another small group of people where they don't do that. They accumulate a lot of financial assets instead, because their consumption needs are just, their income is so much higher than whatever they could possibly consume. Then you can imagine that if you have a shift in the distribution of income from one group to the other group, will affect sort of the balance between how much people are going to be borrowing in society, that sort of balance out the difference. So, like, if the people who are accumulating a lot of financial assets, their incomes are so high, they depend on other people to be borrowing at the margin, creating those assets, and so forth. So, they have a chart in their paper about basically the rise in global household and government debt, among advanced economies, certainly tracks pretty closely the rise in the concentration of income among the sort of like top 1%, globally. There's a neat little illustration of this point, and that's, some point we make in the book too, that's essentially what we've seen in a variety of societies. Where the debt shows up is different, and different. It's not perfectly matched within country by country, which is why we see these trade imbalances. But sort of you zoom out, it's exactly what their point is, which is that you need more and more debt to sustain a system that's that unequal. This is also a point that Marion Eccles, who's a former Federal Reserve chairman, made, talking about the 1920s. So this is not like a new problem by any means, and it's nice that there are a lot of other people who are looking at it and talking about it. And our sort of specific thing was looking at sort of the international balance of payments implications of it, but you can easily look at it sort of either within one country or the world as a whole.
Yeah, definitely. It's about that moving assets and money from people who have a high marginal propensity to consume to those with a low marginal propensity to consume, and those savers have to have a borrower, just an identity in mathematics, isn't it? But yeah, I mean, you can even trace it back. I think your epigraph is taken from John Hobson, which is even earlier, isn't it? So these ideas have been around for a while. And as I said, there's a lot of historical episodes of synchronized debt cycles in your book as well, which show that this is not a new problem, but it's just new characters, I guess, in the story.
Exactly.
If anybody has any questions, please pop them into chat. I know I've taken up a lot of Matthew's time. We've got one here from Tim. Biden inherited Trump's tariff policy on China. If you were his chief economic advisor, what would you recommend he should do?
Well, so I guess the first thing I would say is that I don't think the tariffs were useful for addressing any of the problems we talk about in the book. There's a separate question of whether they were useful for some other purpose. And if that's the case, then, like, you can go in a lot of different directions. I mean, for example, if you think the point of some of the tariffs is to, hold back Chinese development, and you thought that were a good idea, then maybe, I mean, I don't know, right? I mean, they're different. Or you're talking about, like, national security implications of technology transfers. That's sort of a complex. That's not really my area. And this, in terms of what we're talking about in the book, though, I don't think the tariffs were useful at all, and in fact, probably counterproductive. I mean, the thing that you would want to have happen in China is a redistribution of income within China so that Chinese workers are able to consume more. And if your response is to try to raise the price of Chinese goods in the US, then that doesn't necessarily, I mean, sort of either then Americans might buy fewer Chinese goods, but then they'll buy more elsewhere. I mean, what we saw, in fact, exactly is what happened, right? The US trade balance, you basically can't see the impact of the China tariffs in the aggregate level. You can see them on the balance of China. So basically, there was a redirection of trade. But I mean, I don't see why that would really help. So I guess the short version is there are a lot of factors other than what we talked about in the book. But if you're only focused on, sort of issues we talk about in the book, I would say that the tariffs aren't helpful.
Yeah, I think because you can get bogged down in thinking that, oh yeah, it's all about soybeans. But I think what you illustrate in the book is that that's only scratching the surface, and it actually really sort of goes to the heart of perhaps the trade war is a symptom of perhaps what you might say is wrong with modern capitalism, which is the rising inequality and the class war.
Mm-hmm.
The trade war is just one aspect of it. I think, yeah, there's a question from Zhao about the gains and losses from tariffs, but I think you've just sort of answered that in the fact that tariffs are really such a drop in the ocean compared to the impact of actually Chinese overproduction, which is sort of the China shock that David Arter talks about, and how that's taking away purchasing power from American workers. Richard, I don't know if you want to come
I've
in.
got a question, yeah, for Matt. One of the things we're seeing, and which you mention and discuss in detail, is kind of rising markups and increasing, potentially increasing market power for the largest firms. I wondered if you could talk a bit about that. And that's a kind of purely, in one sense, a kind of purely microeconomic thing. It's something that antitrust watchdogs would tend to look at. But there's also an interesting political economy, geopolitical angle on it. For example, before, I'm not sure what's going on with it now actually, but before the coronavirus hit, there was a lot of discussion here in the UK because the French and Germans came out with this paper or this draft of a new industrial strategy, which would explicitly promote national champions.
Mm-hmm.
And so I wondered how you, having done your book, I know you touched on it in the book, but how it's sort of changed your thinking, or what your current thinking is on that interplay between our kind of antitrust regulators on the one hand, and then the need or the desire for big, powerful companies that can play on the world stage.
Yeah, it's a really interesting question. I mean, this does get back to, one of the things we talk about in sort of the first part of the book is that, to the extent that a lot of these, industrialization and national development strategies often lead to sort of weird imbalances, both internally and externally, and often are associated with, not always, but often associated with sort of authoritarian governments trying to produce, national champions and squeezing consumers to get their ends. I mean, that is an interesting question. I mean, you can also sort of imagine it, the cynic view, and I've seen this in the US, is like, Facebook's lawyers trying to say, oh, you can't, do anything to us because otherwise the Chinese will take over the internet. So it can go both ways, and I don't know exactly, what the right way of thinking about that is. I mean, I think, yeah, I mean, it's sort of my gut sense, which admittedly this is not, something we spend a lot of time looking at the book specifically, is that a more, competitive and dynamic marketplace is ultimately going to be better for, producing the kinds of industries that will be really successful and survive, and that, you can easily end up in the, I mean, you look at sort of the Japanese and Korean, experience with this, is you have sort of these domestic oligopolies where consumers are having relatively deprived of choice and effectively subsidizing these big, either chaebol or conglomerates or what have you. But then, those companies do have to compete with each other abroad. And that's like sort of the whole point of the sort of export promotion and like export led strategies that you have there of, well, maybe Honda and Toyota have a nice, don't really compete within the Japanese market, but they compete in the US market. And so that makes them better and, passes on gains. And I think, obviously every country can't do that. But I mean, maybe there's something there that gives you sort of a hint of like, you do need to have competition. And that if you just sacrifice all competition for the sake of producing national champions, I mean, Boeing, right, in the US is an interesting example, like clearly a national champion, clearly very, valuable, but also, it made planes that kept crashing recently. So, I don't know what the solution to that is. I mean, this is something that other people who spend a lot more time on these kinds of issues, these specific kind of issues, know more about. But I mean, I don't know how you strike that balance, but it is definitely a tricky question. I think that, sort of turning off antitrust because you're worried about, losing all your successful companies is not the right answer.
Hmm.
I had a question from Kashif that's come in, which is basically, I think
this is a good question.
basically why the yuan won't become the primary reserve currency, or will the yuan become the primary reserve currency instead of the dollar?
So I think that there are conditions where it could become a major reserve currency, but none of those conditions really are met yet. And so I think, going back to what makes a reserve currency attractive, one of the key things is, if you put your money into assets denominated in this, can you feel confident that you can get it whenever you want, that it's going to be safe, that there'll be enough assets for you to buy, and then that sort of is the corollary to, would you be comfortable borrowing in this currencies? Then you can, you have these, you can hold the stuff to pay your debts, that sort of thing. I mean, that's sort of the dynamic that we're talking about. And the Chinese financial system for a very long time was very deliberately kept closed, where foreigners were not allowed to put money in any meaningful way. That's changed very recently in the past couple of years. But, not to the point that, there's certainly not enough assets in China that people would be able to, foreigners would be able to buy to meet that demand. And it's really not clear, given the priorities of Chinese regulators. I think actually reasonably, I'm not faulting them for this, but I think reasonably they would not want to have their financial system change in such a way that it would be able to accommodate foreign demand, if to really be a reserve currency. The changes that be required, in both in terms of the ability to create a lot of this stuff, and then what that means for people in China, I don't think is something they've shown any interest in doing. And then there's sort of the separate thing, which is like, how confident do we think people in the rest of the world would be about, not having their assets expropriated or being able to get it out when they need it, much less like the complexities of the Chinese legal system, the fact that a lot of people international investors might not necessarily know Chinese. So I think these are sort of like big hurdles that would sort of prevent it. I mean, at a very basic level, if the need of the global financial system for a while has been finding people who are willing to borrow and finding financial systems that are willing to find borrowers and create debt, and that's like what makes a reserve currency is, one of those places that do that, which is not always the case, but it's been the case for a while. It's clearly not the situation with China. And so I don't see that being, that could change obviously, but like until that changes, it doesn't seem like the kind of thing that would make. You don't see this with Europe, by the way, right? Like before people talk about yuan as being the reserve currency, people talk about the euro as being the new reserve currency. And that seems, quite frankly, still to me like a much more obvious candidate, and yet it has not happened. And one of the big reasons is that European leaders are not willing to do the kinds of things that would be necessary to make the euro attractive reserve currency, such as a large, liquid debt market that basically will create new debt to meet investor demand. Instead, they have all these rules basically preventing government borrowing. They have very fractured markets, lots of ambiguity about sort of legal regime when it comes to restructuring, things like that. So, if they can't do it, I don't know why we think China would.
Yeah, and the talk, for what it's worth, Ben and Kashif, who answered the question around when the euro was introduced, exactly as Matthew says, was, I mean, this was definitely going to be the reserve currency, or it was definitely going to challenge for a much greater part of the reserve currency status that it did. There were loads of academic papers that kind of looked at this and made predictions and so on, and it just hasn't happened for exactly those reasons that Matthew states. So I agree. I don't think it's going to happen anytime soon. But then again, the thing I often think about, Matthew, is sort of tipping effects. And I know that the UK sterling area sort of came to an end more abruptly than was kind of expected at the time. So, if and when it happens, could there be kind of a disorderly unwinding, disorderly move away from the dollar? So that was something that was the big, for what it's worth, that was the big underlying risk scenario before 2008. The so-called disorderly unwinding of global imbalances. That's what people were thinking about, rather than thinking about, by the way, the biggest banks in the world have a 99% leverage ratio.
I mean, in a certain sense, there was a disorderly unwinding of balances. They were just wrong about how it was going to happen.
Well,
It
they
wasn't
were,
that,
yeah, exactly.
I mean, you did have a situation where the euro's current account deficit shrank dramatically and Spanish current account deficit shrank dramatically and stuff, but it was, purely a function of people cutting demand rather than like exchange rate. I mean, actually in Europe, it really was sort of the exchange rate is sort of classic emerging market crisis. But yeah, it's I don't know. I mean, the thing about the sterling issue that's interesting is, it was never quite as dominant as sometimes it's portrayed. I mean, it was large, but there were, in particular, like you look at, say, like, Japanese holdings of sterling, but there were a couple of currencies that were, sort of different parts of the world, depending on, what and there were sort of geopolitical implications. So if you're in continental Europe, is much more likely to be, you know, German marks or francs or whatever. The British Empire and sort of broadly construed as sterling. There were the Western Hemisphere is going to be like dollars. So multiple reserve. I mean, there didn't have to be only one, I guess.
Yeah.
So I mean, you could easily imagine, as you were saying, like with the euro, you could easily have like, the euro being a bigger, like you could imagine all three currencies sort of coexisting as, and people using them outside. But I'm not. But yeah, I don't think disorderly. Well, I don't know what disorderly would look like, but I don't think it would be. I think if it were to be bad for, chances are it'd probably be bad for people outside the U.S. if that were to occur rather than inside the U.S.
Yeah.
Would be my suspicion.
I think we're almost out of time, but I think Linda is very keen just to get her last question in, if that's okay, Matthew.
Sure, absolutely.
She's asking, what should be China's next step? But should we put that in the context of, has the pandemic changed anything about what China's next step is beyond your book? Yeah.
So the pandemic is interesting because it really exacerbated some of the problems that were within China. So if you look at how the Chinese government responded to the pandemic, it was basically providing a lot of cheap loans to businesses and intervening somewhat surreptitiously to prevent the currency from appreciating more than otherwise would have. Rather than providing a lot of income support to households. There really wasn't much use of the unemployment benefit system, which wasn't very big in China anyway beforehand. You had big migration of people with rural household registrations from the cities to the countryside. At one point, I think people in China really said like 50 million people moved. Some of them may move back. I don't know, but I mean, because you don't have unemployment, jobless benefits, so you have to move to be a subsistence farmer. And so the net effect of this was that even though the Chinese economy grew in 2020, which was relatively unusual among world, major economies, retail sales and household consumption shrank. In fact, it shrank more in China than in, say, like the U.S. It was made up for by the fact that you have this big increase in infrastructure investment and a big increase in exports and manufacturing production. And so, that's basically a reversal. To the extent there had been an improvement over the past few years, very small improvement, that's a pretty big reversal of that. Probably setting back several years. I mean, we don't have the full data yet to get like a real picture of where things are, but like probably setting it back several years. Now, to be fair, Chinese leaders seem to appreciate this, and you look at the stuff they were saying in December about demand side reforms and trying to figure out how to increase household income and consumption, and that seems like it's very directionally correct and in line with what we've been talking about. But Michael's been living there for almost 20 years, and they've been saying this for a while, and it hasn't happened for various reasons. In part because despite sort of the perception that we might have that it's autocratic dictatorship, it's the Chinese politics are very complex, and I'm not going to pretend to say that I understand them all, but like there are a lot of layers and a lot of people of influence. The provincial governments have a lot of power. There are a lot of factions and ability to. So someone at the center might say something, and unless they make it, they are convinced like that's their number one priority. It can easily not happen. There'll be a lot of pushback to it, and so that's why, despite this kind of rhetoric in the past, you haven't seen the kinds of changes that be really constructive. Now, this time could be different. I'm not saying that like it's destined to never happen, but it's something we should be sort of cautious about. But they are saying the right things now, so that's at least encouraging.
Change is always difficult with vested interests.
Yes.
Perhaps we need an FDR, traitor to his class scenario politician in China to sort it all out. But thank you very much for joining us, Matt. It's been absolutely brilliant.
Thank you very much for having me.
Cheers. See you all next week.